Hello, welcome back. Here is Ali Talibi, and this is our third lesson from Module 7. So we started our module talking about the stock, and I introduced you to some basic concept related to stocks, and then we started our stock valuation concept. So we talk about using comparables to find the stock price. There are more complicated ways of finding the intrinsic value or the true value of the stock price. So in this lesson, I'm going to talk about one of the most popular approaches in stock valuation, which is called DDM, dividend discount model. There are several versions for the DDM. One is no growth, so we assume there is no growth in the dividend. Second version, we assume the dividends are growing at a constant rate. And finally, we'll go with a more realistic approach when you have a non-constant growth. In this case, for some years, the dividends are growing with a kind of irregular rate, and then after that, they go back to a kind of normal rate. So we'll talk about that, and I will show you how to find the price under different scenarios. So when it comes to finding the stock price or finding the value of any asset, we argue that you can find the value of any securities or assets by finding the present value of all future cash flows. When it comes to stocks, the major source of cash flow is the dividend. So the companies are actually paying out, making money and paying out part of that money they are making to their shareholders. So we can use that dividend to find the present value of the stock. So in other words, what we need to do, we need to find the present value of all these dividends. So that's the whole argument. What's the current value of the dividend 1 year from now, 2 years from now, or actually 8 years from now? So that's the whole idea here. So if you find the present value of all these cash flows, you can find the current value of the stock. Now, if that's true, we have to be clear in terms of the dividends which are paid to shareholders. How much dividends they receive, is that kind of growing, is not growing. So that's the major argument here. So we go with the most simplified version of the DDM, in which we assume there is no growth in the dividend payment. So in other words, the company is paying the same fixed amount of dividend for every period or for every year. So you are dealing with the type of cash flow which we learned in module 5, and we call that as perpetuity. You are right. Perpetuity was the cash flow with a fixed amount, same number for the unlimited period of time. So you can assume that's a kind of perpetuity. So we learned that to find the present value of the perpetuity, you just need to divide that payment by the discount rate or the interest rate. So there's just one dividend, when I'm saying one dividend, I mean one same fixed dividend, which you receive over time again and again, the same number. If you divide that payment by the interest rate or discount rate, you can find the stock price. So very simple. Let's assume the company is paying $2 on annual basis. The appropriate discount rate is 10%. Now you tell me, what is the current price of this stock? You're right. If you divide $2 by 10%, you will get $20. So $20, that's the current value of the stock based on this approach and based on the assumptions we made. But let's make it a bit more realistic. Usually the companies are paying dividend, but the dividend payment is growing over time because there are several factors, because of the inflation, because the company doesn't need that much money over time to reinvest in the operation. So they're paying out more money to their shareholders. So we can use the constant growth model of dividend discount, in which that we can assume the dividends are growing at a constant rate over time. So this time we're talking about perpetuity itself, but this is a specific form of perpetuity. This is growing perpetuity. The perpetuity is growing at a constant rate. Now, we learned again from module 5 that the formula for the present value of the growing perpetuity is dividing the first payment by discount rate minus the growth rate, as you see here. And the first payment here is the dividend 1. So that's the first dividend you will receive. And R is the discount rate, and G is the constant growth rate. So if you use this formula, you can find the present value of the stock. Let's go with a very simple example. So let's assume the company is going to pay $2 as the first dividend. So your D1 is $2. The appropriate discount rate for this company is 10%. The dividend we expect to grow at the rate of, let's say, 5%. In this case, what's happening? You can calculate the stock price by dividing $2 by 10% minus 5%. So which is $2 divided by 5%. So in this case, the stock price should be $40. So given this assumption, you can calculate the stock price. I will talk more in the last lesson of this module when it comes to review and offering some hints. I will talk more about this formula. This formula is also called Gordon. Gordon was the first person who came with this idea, Myron Gordon. So this formula is also known as the Gordon formula. So I will talk about this formula in further details, but for now, that's how we use this to find the stock price. We can make it a little bit even more complicated. So we can make this a little bit more complicated because we'll see in many cases the companies, especially those who are just started their business or who are just started to pay out dividend. In some years, you will see since they have lots of cash flows, the dividend growth is huge. The dividend is growing remarkably, but after a few years, they go back to kind of normal growth rate. So we have non-constant growth for these companies. So in this case, it's better to use a kind of two-stage formula to find the present value of the stock. So what I mean by the two-stage. So let me provide you an example and show you how we can find the present value of the stock in which the company is paying higher dividend in early years, and then the dividend growth is getting back to normal. Now look at this example. Here is the timeline: 1, 2, 3, 4. Let's assume dividend 0 or D0 is just $1. However, the company is performing very well, and next year it's paying 50% additional dividend. So it's going to $1.5. Also in year 2, the dividend is growing another 50%. So it's going up by another 50%. So it's going to $225. So here the growth rate is the growth rate of dividend is 50%. Also the growth rate here is 50%. But after 2 years, the company is settling down, it's getting back to the normal dividend payment, and then we can assume a normal growth rate. Let's say the normal growth rate of dividend is just 5%. So from here, we have the normal growth rate of dividend as 5%. So I call this super normal, and here is the normal growth rate of 5%. So starting year 3 or the end of year 2, the dividend is going to grow at 5% constantly. So 5%, 5%, and so on, so forth. So in this case, your D3 should be you should grow the D2 by 5%. So in other words, your D3 should be 2.25 times 1.05. So it's going up by 5%. So let's calculate the dividend. So it's 2.25 going up by 5%. So it gives you 2.36. So it should be 2.36. $2.36, that's your dividend year 3. And you can calculate D4, D5, but you don't have to do this. It's much easier. Just stop when your dividend growth is becoming constant. Now, I mentioned there are 2 stages to calculate the present value of stocks when the dividend is not growing constantly. So in this case, what you do in the first stage, you need to find the stock price at the time when the dividend growth is getting back to normal. So choose the timeline in which, or the time spot in which the growth rate is changing from super normal to normal. So in our case, you see that at the end of year 2, the growth rate is going from 50% to 5%. So that's the timeline I mentioned. So that's the highlighted part. So you have to find the stock price here. So that's what I'm going to do. I'm going to find the stock price at the end of year 2. So let me just call this P2. P2, that's your stock price 2 years from now. We learned based on the Gordon formula, or the DD, that since the growth rate from year 2 here is normal, we learned that we can use the Gordon formula to find the stock price. So based on the Gordon formula, the current price was based on the following year dividend. So I can use D3 divided by R minus G. That's the formula. Again, be careful. This is P2. I'm using the following year dividend, so D3. So what is my D3? I already calculated the D3, which was $2.36 divided by. So what is your R, or discount rate? Let's assume our discount rate, appropriate discount rate, is 10%. And minus G, and be careful, the G, that's the normal growth rate. That's the constant growth rate. And in our case, that's 5%. So if you divide the dividend by the difference between the growth rate and the discount rate, you can find the price 2 years from now. So that's 2.36 divided by 5%, which gives you $47.20. So this is $47.20. That's the price 2 years from now. But we haven't done yet. I mentioned that's a two-stage. It was the first stage. In the second stage, we argue the stock price is based on the present value of all future cash flows. So here you can assume that 2 years from now, you're selling your stock at $47.20. That's one of the cash flows. So what you need to do, you need to find the present value of this P2, because this is happening 2 years from now. Do we have any other cash flow? Yes. You also receive the dividend by the end of year 2, $2.25. So the first portion, that's a P2 you have to discount. The second portion, that's the dividend 2. Another portion, that's the dividend you also receive 1 year from now. So I have to discount it back as well. So I have 3 cash flows I need to find the present value for. Again, one is the dividend 1 year from now, dividend 2 years from now, and how much I'm going to sell the stock 2 years from now. So if you find the present value of all these cash flows and add them all, you will find the stock price, which is the current value, the current present value of all these cash flows. Just before I forget, remember that you don't discount the D0, you don't include this D0 or D0 here. Why? Because it's already gone. D0, never include that in your calculation for the stock price. I will talk about this again in the wrap-up session, but for now, don't include this. Am I allowed to include the D3? No. Why? Because this D3 is happening after normal growth rate. It is already reflected on the stock price here. So you don't need to include that in the present value anymore. It's already part of the P2. So don't count twice. Don't include dividend 3 twice. You already included that. Now let me just find the present value of all these cash flows and add them all. Again, for the present value, that's a lump sum. You just need to divide this by 1 plus R. So we learned that when it comes to present value, the present value of any cash flow, that's the future value divided by 1 plus R to power of n. And n here it's showing that for how many periods you are going to discount it back. This is 1 period, this is 2 periods. So I'm just going to plug these numbers and find the present value for each cash flow. Well, I just calculated the present value. As I mentioned, I use this formula to find the present value of each cash flow. The present value of $1.50 1 year from now is $1.36. The present value of $2.25, 2 years from now, it's $1.86. And the present value of $47.20, 2 years from now, is $39. I'm adding all these three numbers to find the present value, which is $42.20. As I mentioned, I assume the discount rate, the appropriate discount rate is 10%. So that's the discount rate I use. So when you have the non-constant growth stocks, that's the formula you use to find the present value of a stock. Just find the present value of all these cash flows, and then you're done. We talk about the G, or the growth rate, and we mentioned that the growth rate might be constant or non-constant. However, we didn't talk that much regarding the calculation and how you can find the growth rate. So now I'm going to talk about the growth rate and how we can estimate the growth rate of the dividend for a specific company. So different companies, they have different strategies in terms of the dividend payment. Some companies are paying higher dividend, some companies are paying lower dividend. I mentioned, if the company is expecting to grow fast and they need lots of cash to reinvest in their operation, usually the dividend payment is very low. However, if there are not many opportunities to invest on, and the company prefers to pay out most of its cash to shareholders in the form of dividend. Now, the portion in which the company is paying dividend to its shareholder is called actually payout ratio. So payout ratio is showing what percentage of earnings is paid out to investors. So that's a payout. So whatever is left, it's called retention or plowback ratio. So the plowback ratio or retention ratio, it shows what percentage of the earnings is left or remained in the company. Why this is kind of important to us to know the retention or plowback ratio? It matters to companies. Why? Because it shows, it indicates how much money they have in their hands to reinvest in their operation, to go with new projects, and they look for new opportunities, and they use that cash, that money, to invest on those opportunities. So that's the whole argument. So that's one major factor which determines the growth rate of the company and the growth rate of the dividend. The second factor here will be actually what the company is doing with that money. So let's say the company has $1 million available to invest. But the question here is, are they going to waste that money? Are they going to find good investment opportunities? So the second factor here, it becomes the return on equity. It shows how much profit or net income is the company is making from the money it received from shareholders. We remember the ROE was the net income divided by shareholders' equity. So ROE is a very good indicator, which is actually measuring the performance of the company in using the money it collected from shareholders. Now, if we collect these two pieces of information, and if we put these pieces of information together, we can find the growth rate of the company. So as you see, if you multiply the ROE, return on equity, times by plowback ratio, you can find the growth rate. As the return on equity is going up, and as the money which is left at the company is going up, the company is holding up more cash in the company, the expected growth rate should be higher. So this formula is called sustainable growth rate. So that's one way you can estimate or you can measure the growth rate, and you can use this number when it comes to Gordon formula and you want just to find the present value of all these future dividends. That's the growth rate, appropriate growth rate you can use to find the future dividends, and based on that find the current stock price. That's it for today. Thank you very much. Here is Ali Talabi, and I will talk about more valuation approach in the next lesson. Have a wonderful day. Talk to you soon. Take care.